Hey everyone, it's Imran back again with another macro options spotlight. All right, so markets, trading the swings in markets over the last year, I would say has been very much about not just monitoring the fundamentals and the technicals, but sentiment has played a big factor, right? That's why we brought on Jared Dillian, the sentiment guru, on our Trader Chats episodes. I recommend you check it out. But basically, monitoring sentiment has been important to get a sense for what the next swing is likely to be. Now, the latest spike, the charts, looking at the charts, you can see the latest spikes in sentiment show that the bears are just capitulating, right? So we've seen the price action in the big shorts like Russell and like the regional banks. But this AAII bull bear survey really does show the bears are capitulating back down towards, multi-year type lows. And the bulls here are now above any time we've seen this year and even the whole of last year, basically. Right? These levels have not been seen since Q4 21 in terms of the kind of number of bulls in the survey. Okay, we did see obviously a bit of bullishness emerging at the start of the year, but that was all down to the China optimism, and now you see how that's turned out. But this move seems to be coming from the idea that the U.S. economy is more resilient than expected and can handle a more hawkish Fed. And then you've also had the whole AI revolution, like just firing up the sentiment on tech stocks to the absolute moon, right? So that's really what's driving this bullish sentiment, in our opinion, those two things. We do think chasing the bullish sentiment appears dangerous right now. Generally, if you have piled into the market at places where sentiment has got this bullish, it hasn't served you very well in recent years. But then we haven't been in like an outright bull market for some time. So there's an argument that on the Goldman's indicator, we would need to go a bit higher to go to stretched positioning on the bullish side before it's actually worth taking on a short, right? But certainly I wouldn't be adding fresh longs here. We think, having some upside calls in your back pocket doesn't look expensive with single digit volatilities available on things like S&P on the upside. But we would be cautious about being overly exposed to the market right now. I think the aim of the game is finding cheap ways to participate in upside without overcommitting. That's the way to go here, right? In my opinion. All right. So that's the general sort of macro sense that I'm getting right now. Looking over at the dashboard, we can see stocks did bounce yesterday. You had initial jobless claims come in higher than expected. That helped yields reverse from recent upside. So yields came back down a little, sparked a rally led by tech. Commodities also cheered the fact that we had a weaker dollar. On a weaker data gave the dollar a pullback down to 103.5 on DXY, but oil did still remain heavy. So whilst we saw decent rallies out of gold and silver, oil couldn't really rally and finish down 2%. Okay, and then also bonds had a bounce. So we see TLT up over 1%, kind of recovering most of the weakness from the previous day. And then ARC once again outperforming other sectors, up 1% in the green, as the high duration stocks benefit from the idea of yields coming lower. Equity skew bounced in NASDAQ and Russell. So we've been saying it got a bit oversold, but it does remain historically very cheap. If we look here, single digit percentiles in everything except the FTSE right now. And then in commodities, we saw skew generally softer across the board, with the most weakness really coming out of uranium resetting a bit lower. And uranium's been trading very well recently, right? It seems to have had a little bit of a mini breakout here on the upside. So maybe some sentiment shifting that we're going to get a proper rally out of uranium at some point. We've generally not been in it in recent times in terms of options. I do own a decent chunk of my long-term portfolio in uranium. That isn't about to change anytime soon. That's like probably a decade-long view, in my opinion. So I'll be happy to see the uranium rally as and when it decides to start. Okay, and then generally outside of that, FX and bond skew completely unchanged, not really doing a lot. Looking at vols, we saw vols in the US and Europe continuing to drift, somewhere between quarter and half a vol. VIX is back on a 13 handle. China vols did pop a point though, even though China was up. So that's interesting there. Silver vols were firming in commodity space as we saw a good 2.5 sigma rally out of silver. But if you look at other vols in commodity space like nat gas and uranium, they were down about 1.5 points. Equity indices do remain in negative carry here, so suggesting you don't really want to be overly short gamma, even though, it's worked pretty well for the last few months. Just right here, right now, on a 10-day basis, it's not showing as doing very well. And we've also got negative carry in the likes of gold, oil, and uranium. FX pairs wise, flipped into negative carry as well in a few pairs like euro, sterling, and Swissy, as implied vols just keep drifting, and we had a bit of a move in the dollar yesterday. And then ARC showing pretty deep positive carry there, out of all the sectors, all in red except for that one, as it just seems kind of, remember, it's still on a high 30s vol, and it's only realizing 14 right now, which is incredibly low. Now, it has had some intraday swings, but close to close, it's just fallen off a complete cliff. Now, we did put on a bit of a positive carry trade on ARC at the start of the week, talked about some put calendars. If you think we're going to continue to get more hawkishness out of either CPI or FOMC next week, and we would like to see those tech names have a pullback on that. Remains to see if that's going to happen, but we did think that ARC would struggle to sell off materially this week, and that seems to have been proven right for now. Okay, seeing as it is a Friday, so I think I can safely say that call that we did not sell off hard this week. All right, then what else are we looking at? We're looking at the VIX. Volatility continues to be the most hated asset in town. So the VIX really getting crushed. You can see that this wave of red, these red bars on this is our VIX monitor from our weekly report that we do for our weekly subscribers. So we analyze what's going on the VIX. So you can see VIX plus the front two futures have all collapsed. You can see the different term structure and how it's, it is a pretty steep contango, but it has kind of collapsed in a more parallel fashion this week because it's been steep for a while. You can see here what VVIX and VIX itself have been doing. So VIX has really got smashed down. That's the green line. VVIX has come down, but it has found some support here, basically, right? So we're seeing a little bit of divergence there. The roll down in the VIX has steepened massively to around 12%, which is pretty much about as steep as it gets. So again, that's showing you how steep the curve is. The VIX beta that we look at is at 3.5, which is pretty close to 2-year averages. So it's not telling us a whole lot, the VIX beta. You can see here in terms of the open interest landscape on the VIX, the green bars represent June, which is expiring on the 21st. It's a pretty uniform distribution from like 15 all the way up to 30 in terms of VIX, right? So that's interesting, just in the fact that, there's strikes all over the map. Now, clearly we are trading at 15 down here. So there is going to be time value evaporating off all of these upsides, basically, right? And if we make the assumption, it's generally a fair assumption, that clients have been buyers of these VIX options and dealers are short these VIX options, right? Then that basically means that think about it like if dealers are short upside calls, that's presenting them a delta short position. That's going to decay away through time, and they're going to have to replace it with futures. So there may be a charm effect over the next 2 weeks that keeps a lid on the VIX because of this. But the fact that we've overshot and sold off so much, maybe that's a lot of that has already taken place and already happened. And that's actually maybe what's been driving the VIX down, that all of these upside call open interests have just been evaporating. Premium's been running off those, which means the delta's been running off those. And the dealers who have those positions have had to replace that with shorts that are basically, driving the VIX futures lower. Okay, so that's what we're thinking about. And then as the bears have thrown in the towel, as the vols come down so hard, we said obviously correlation's been crashing. It's been a factor. We've seen a bit of a pop-up activity in the 15 strike puts on the VIX. So that's the at the money strike. We do still see activity on the upside in the likes of September expiry and July. So we think any call buying has generally been focused on those longer maturities because people are saying, well, in the near term, VIX isn't popping, but you do have this very steep curve to contend with if you're buying upside calls on VIX right now in any maturity other than June. Okay, that's something to be aware of. So what would we do? Looking at our vol dashboard on VIX, we see we are in buy calls just because we're very oversold. Looking at the Bollinger Bands, it just smashed through the Bollingers on the VIX. So we are sitting here in buy calls. The term structure has collapsed. We did have a put calendar on, ratio put calendar on the VIX to try and play the downside on the VIX. Turns out we were right about the VIX going lower, but we just completely underestimated how violent that move could be in June. And so we didn't make any money off that trade. So I stopped out of that trade yesterday for close to flat, just because I was like, this trade has not acted how I expected it to act. So it didn't make sense to keep hold of it anymore, right? So I've got rid of that. But now I'm looking at the upside on VIX and wondering if there's a trade here on the upside. We've still got very positive vol carry to outright calls, whilst the skew is still pretty expensive for those upsides. And we said the vol of vol is not exactly collapsing quite the same as the VIX. Outright calls don't make ton of sense right here. All right, that's the trade idea for today. Have yourselves a great weekend. I'll catch you all next week. Cheers.